Welcome to Beyond by Wings, the business side of dentistry, brought to you by Edwards & Associates PC. Join us as we discuss how to build your dental practice, optimize your income, and plan for your future. This podcast is distributed with the understanding that Edwards & Associates PC is not rendering legal, accounting, or professional advice. Listeners should consult with their business advisors before acting on any of the information that is shared. At Edwards & Associates PC, our business is the business of dentistry. For help or more information, visit our website at enassociates.com. Hello and welcome to another episode of Beyond by Wings. In today's episode, we have a very special guest. His name is Paul Montelongo. And, the reason why we decided to do this episode with him is because, he's a bit of a real estate investor, so to speak, right? And I'm sure when I pass the mic back to him, he's going to say more about what he does, right, in more elaboration. It's also because the kind of listeners we have, the kind of clients we have, they're very much interested in the kind of investment options that you guys are offering. Yeah. So without further ado, can you tell us a little bit about yourself and what you guys do?
Absolutely, Ash. Good to see you. Anyway, Paul Montelongo from San Antonio, Texas, founder of Montelongo Capital. And what we are is an investment firm that partners with business owners, physicians, dentists to invest in cash flowing real estate for tax benefits and for equity benefits.
All right, perfect. Now, expand a little bit on the cash flowing investments bit.
Sure. So we buy assets that cash flow on a monthly basis, apartments, self-storage, lease spaces, and oil and gas. We also buy that kind of asset as well. So that we're interested in three things. We're interested in the cash flow. Right. So it's got to generate monthly revenue that surpasses all of the debt, of course, so we can divide up the profits with our investors. And then secondly, we want good equity. Like these are assets that are going to appreciate because we put the work into these assets to force the appreciation, to build the appreciation over the life of the asset.
I see.
And then third, and maybe most important, is tax benefits.
That's right.
And so since most of our investors are business owners on their own, they have their own independent businesses, not in real estate, they're doing something else, and they have investable money, but they also have a tax situation that they have to take care of. And so real estate's perfect for that. Real estate, oil and gas, those are perfect assets to help offset your tax liability. And so we work with investors to help them with their tax situation. And we are what's known as owner-operators. So we do the day-to-day operations, we take the rents, we do the management, we handle all the problems on a day-to-day basis, and then the investor is a limited partner or passive investor. They get to share in the benefits. And by the way, it's usually they get more of the profit than we do as the general partners on most assets.
Now, would it be possible for an interested investor to join in as a GP, as a general partner?
Yeah, there's a possibility for investors to join as a general partner. This would give them additional tax benefits.
That is correct.
Right? And so we have partners throughout all of our investments that have come on from different industries. They bring different specialties, different skill sets, different job titles and roles to the investment. And we partner with them all the time. Just a little interesting note, we have a general partner in one of our deals, and he's kind of an expert in finding local, municipal, and city tax benefits and benefit programs. So more of a social element to our investment. So he's become the social director, not social media, because that's another role,
that's a whole different role.
But the social director for our investments in the local areas in which we invest.
Okay, wow, that's amazing. Now, how long have you been doing this?
Well, I've been doing this particular business for 11 years. Prior to that, I was in single-family residence, and I did many, many, many flips. I started flipping when I was 21 years old.
Wow, that's amazing.
Yeah, that's a long time ago. But
really?
not.
So people can't see us. But even if people can see you, man, I don't think they'll be able to tell.
Okay, let's go with that. I appreciate it. Yeah, but so for a long time, single family residences, fix and flips, And then in 2013, I got invited to buy a marina in North Carolina.
Wow, that's amazing.
So to partner with some people to buy a marina, and that really gave me a taste of this multi-unit type, multi-revenue generating type properties. Because that particular property had 115 boat slips and had 38 tiny homes.
Wow.
And then it had some storage, and it had some parking, and it had, at one point it had 13 streams of revenue. Well, that's
from one marina.
From one marina, for one piece, for one tract of land, 14-acre tract of land. And that's hundreds of checks coming in each month.
Right.
From a variety of sources.
Right.
So that gave me the taste. That was like, okay, I see, rather than a transactional investment like a flip, you buy a flip, you buy a house, you fix it, you sell it, you get paid, and then there's another one, and there's another. So those are singular or transactional events. Whereas multifamily, multi-unit, storage, those kinds of asset classes, you have one close, you have one transaction, but then you have multiple streams of revenue. And so that increases your opportunity to make money. It also helps defer some of the risk in a property. So that made a lot of sense to me. And so then I doubled down and I started doing that.
Okay, that's good. Yeah, let's talk a little bit about the multifamily syndicates,
Sure.
right? So typically when you acquire a project after you have raised the funds that you're looking for and you go through with the deal, how long do you typically keep it before it's sold to another investor?
Yeah, traditionally these are 5-year business plans.
Okay.
Historically though, and our track record is we hold for about 33 months.
Okay.
But they are based on 5-year business plans.
Right.
If it would go into a 6th year, it would just be because it makes sense, or maybe the market is telling us it's not quite ready to sell.
Right.
But the other side is true also. We can have a 5-year business plan, and what's happened up until now is the market tells us, okay, your property is ready to sell for optimal value at 33, 34, 36 months, that sort of thing. And so then we sell, and then we divide up the profits to the investors, and we go to the next one.
Okay, good. And during the entire time, the cash flowing investment, right?
Yeah.
Is it generating the cash per month, per quarter? When do you guys typically hand out the distributions?
So we issue distributions quarterly.
Okay.
And then on some of the properties, some of the investments, we have a preferred rate of return.
Okay.
Others, we have just a straight rate of return, right? So based on whatever the property is generating.
Right.
And so, it's all in the business plan.
Right.
It's all disclosed. It's all formal. And then based on our experience, based on the market, based on how we think we can generate the most value in that property, then we decide, are we going to distribute quarterly? Are we going to distribute monthly?
Right.
For how long? Those sorts of things, right?
And how involved does an LP need to be?
LP, well, let's go back. First of all, an LP has ownership.
Okay.
Right? LP has ownership. You're in the LLC that owns that particular asset.
Correct.
It's just that you don't have the day-to-day responsibilities that the general partnership has. And having said that, LPs have all the disclosure rights, have all the availability and all the accessible rights that a general partner would have. It's just that they don't get involved in the day-to-day operations, right?
They are truly there. The LPs will have the true passive.
They're passive.
Part.
They're passive, right?
And
And that's ideal for the investors that we bring on, because these ladies and gentlemen, they're operating their own business.
Right.
Like we have people from the dental industry, we have people that are physicians, oncologists. We have people that run trucking companies, roofing companies, meat supply companies, plumbing companies. So these individuals, they all have their own profitable businesses, and they're locked down on operating their businesses. Yet they have this deployable money for real estate investments, and so we provide the done-for-you model.
Right.
Like we do all the due diligence, we do all the operations, we do the acquisitions. Our team does all the operations. I obtain the loans. I guarantee the loans myself.
Okay.
And so then they come in and are passive investors. Yeah.
Oh, I see. I see. Okay. That's good to know. Now, the other thing that I'm also thinking about is, are there any current projects going on right now where you guys are actively looking for investors?
Actually, we do. We have one property in Corpus Christi, Texas, that we've already purchased. Here's the nuance of this property. Okay. First of all, this is our second property in Corpus Christi, Texas.
Interesting. Okay.
We like Corpus Christi, Texas, and I'll tell you why. First of all, it's a working class community for the most part. Blue collar workforce housing is what we buy. And so we bought our first property there in December of 2022, okay?
Nice.
And we bought it just a few hours before the end of business ended that year.
Wow.
1 week later, an article comes out that Elon Musk and Tesla are building a lithium battery plant in the Corpus Christi market area. And that did not come up in our due diligence. We're like, oh, wow, we must be living right. Because what does that do? That brings jobs.
That's right.
That brings income, you know, and those people need a place to live. And so workforce housing is that supply. So we like Corpus Christi. And then in March, which is now, 4 months ago or so, we bought another asset in Corpus Christi, about 10 minutes away from our first asset. And we paid $6 million for it. We've already transacted on it. We've already closed on it. We're already in the middle of operations. We raised enough money to purchase the property and to begin all of the capital expenditures, the improvements, the rehabs. And so now we're just raising just the balance of the capital raise just for some more reserves and what ifs and those kinds of things. So there is an opportunity on the table right now for an investor to come in and invest in one of our properties. That particular property is projected to generate at sale, when we look back, it's projected to generate 20% per year return on investment.
Really?
That's right. So that means if a person invests $100,000 at the end of 5 years, they'd get their original $100,000 back, and then they'd get another $100,000 on top of it. And so you divide that by the 5-year business plan, that averages out to 20% per year. That also has a 7% preferred rate of return. So that means every year that an investor will get 7% on their money in quarterly distributions. 7% annually, of course, spread out over the quarterly distributions. And so you take the 7, and there's no word guarantee in our business, but it's called preferred rate of return. In other words, investors get paid first. So from the profits, from the net operating income that is generated on the property, limited partner, passive investors get paid first, and then general partners get paid second. So the first 7% goes to the limited partners, and then if we generate more than that, then there's a share. Right. So,
and for the interested listeners who are maybe considering looking into the GP route for tax purposes, almost always it's more than 7%, right? The rate of return.
Yes, definitely.
So you are still going to get a decent amount per quarter.
Yeah. Well, like I said, once we look back on it, it's projected to you're projected to see 20% per year. That's pretty strong. There's not many other investments, standard traditional investments that'll generate that kind of return on our investment. Right now in 2024, since we're doing this in August of 2024, the economy and interest rates and real estate it's in an adjustment period.
That's right.
It is not by any chance low or in trouble. It's just adjusting, because we saw it so crazy in 2018, 2019.
That's right.
The beginning of 2020. We saw it so crazy on fire that now it's adjusted a little bit. So what does this mean? This means that over the next 2 to 3 years, 3 or 4 years, that it's going to crawl back. And we're going to see the values go back up again. So the properties that we're buying right now in 2024, we're buying them at about 22 to 25% under market value.
Okay, how are you guys getting that leverage? Cash? You guys have a lot of investors that are...
We have a lot of investors, and we get good debt.
I see.
So we get about 65% of the purchase price in debt. So we have a mortgage loan, and then the balance we go raise from investors, from passive investors. And
that's actually pretty good. 65% is pretty good.
65% is good.
It's a lot higher,
The property that I was just referring to, we got 67% leverage on it, right? And these are agency loans, they're federally backed loans, but they are also asset-based loans. In other words, the asset has to produce and generate enough income, enough revenue to cover the debt and more, right? And so that's a condition of getting the debt.
And that's important to know, because if you are thinking about investing, you would want to know that if the potential asset that's going to generate revenue for you has been vetted, right?
Absolutely. Think about the math on this, okay? For those math people out there, you buy a piece of property and you only get 65% leverage on it, right? You can only get a 65% loan. That means that inherently you have a 35% upside, okay? They are being purchased for about 20 to 25% below market, as I mentioned. So now a property is it's about 110, 120% upside on the day that you purchase it. Now, obviously, there's some equity that has to be invested, and that all goes against the cost and everything. But in terms of the property itself against the debt at the day of closing, there's an upside. And by the way, these properties are all appraised, and they have to be appraised well over the purchase price in order for us to obtain that kind of a debt, which they are.
And you did also mention something important there, which is you guys will always make sure that the income proponent of that investment will always be higher than the mortgage that you acquire. Right?
Absolutely.
So I'm assuming maybe through a variable rate plan or something, right?
Well, it has to be. Yeah, it has to maintain a minimum of 25% more than the debt. It's called debt coverage ratio. So
that's right.
Yeah. So typically these are 35 to 50% more than the debt, but the minimum as required by a lender is 25% more.
Right. So, that's awesome. That's
yeah.
amazing.
But it all goes into the formula. It all goes into the business plan. And by the way, I'll just mention this. I'm a business owner. I've had many businesses in my career, and I've generated lots of revenue through these businesses. And so when I got into buying these kinds of properties 11 years ago, immediately I decided that these are businesses I'm buying. Oh yeah, I'm buying real estate, of course, but the reality is I'm buying a business. So if I buy an apartment complex, I'm buying the business.
That's right.
I'm buying the real estate. I'm buying the doors, the buildings, the dirt, but I'm also buying the personnel. I'm also buying the website. I'm also buying their equipment. I'm buying their customers, called tenants. I'm buying their really good Google reviews, and I'm buying their really crappy Google reviews, right? In other words, I'm buying the entire business. And so it's our job to go in and reshape the business, give it a new business plan, bring it up so that it has value, so that its resale value is good for the investors.
Right. Yeah. No, I do really appreciate you being here on the episode today, just because I know when I'm talking to my clients, for instance, after a certain point, just funding a 401k plan isn't just enough. They still have overflow of funds that they've generated. And oftentimes they always think about, okay, maybe I should put some money into a CD. Sometimes they even forget about it, and they're just sitting in a crappy savings account where it's not even generating 1%. So that is where we have to come up with ideas on how to, diversify some of the funds that are there, so they can invest in areas where they can generate a good, significant return. Now, one of the things that was a big buzz amongst my clients, and I'm sure with some of our listeners, is the potential to invest in multifamily syndicates as well as storages, self-storages. If you even go on TikTok or something, I think that's where they get a lot of their information in reality. I'm not going to lie. They go like, oh, okay, what are some of the investment options out there? And they goes like, oh, self-storages. Okay, I need to talk to someone about self-storage. Right. So having someone like you in the area and in this specific industry that can talk quite a bit about it, it's very helpful.
Yeah. That's funny you say that, TikTok.
Really?
Yeah.
It's true, though.
It's true. It's very true.
Yeah.
People go and they go, oh, TikTok's, it looks good on TikTok.
Yeah.
Must be a real thing. It's like you would vet a dentist. Does this person have experience? Do they have knowledge? Do they have referrals?
Right.
What's the history of their current customers? The same thing with an investor, multifamily storage investor. What's the track record? How are they going to handle the business? How are they going to handle my investment?
That's true.
It's just a vetting process. And you mentioned something interesting in that what you do, you help with the financial planning and the accounting for dentists and professionals,
and the
in
tax
general.
side of it too.
And the tax side of it. The tax side of it. Right. So
that's right.
K-1s are issued every year.
That's right.
And so you help them with their tax side. And these investments qualify for retirement fund self-direct, self-directed IRA funds. So oftentimes, and we have a lot of investors that they have money from an IRA account that got there through some company they worked for many years ago. And it's just money just sitting there at 2 or 3% interest, maybe 4% interest if they're lucky now. But then since the government allows those funds to be directed into qualified investments, and real estate and oil and gas are one of those, investments that qualify for self-directed funds, it makes total sense to place your money from your IRA to self-directed into these kinds of investments, right? And so And then the IRA money acts the same way it's always acted. So like when we pay distributions, we pay it back to the IRA. You don't get to touch it until you're 59 and a half if you don't want to be penalized. When you're 59 and a half or beyond, then you can draw the profits out.
That's right. Yeah. That's tax-deferred growth.
Tax-deferred growth, right?
Yeah, so you're compounding on it.
So technically our investor is the IRA fund, not you.
That's right.
But you get the benefits of it.
That's true.
Yeah.
That's true.
Yeah.
That's
so there
true.
are a lot of ways to make it work.
Uh-huh.
A lot of ways to make it work. I think the main thing is that you want to find an expert in the industry that knows how to manage properties, how to buy properties correctly. And then, as I mentioned earlier, it's a done-for-you model. We do all the operations, all of the management, and then the distributions go out.
Okay, perfect. Yeah, that's amazing. Well, thank you so much, Paul. That was a lot of valuable information for our listeners, including myself. And it was nice to run into you here today.
Yeah, good to meet you as well. Of course, anybody wants any more information, go to MontelongoCapital.com. There's all kinds of free resources there for investors, for physicians. There's even one for physicians, a resource for physicians, right? And we have events, and we have education, and we do what we can to help people understand the investing market and how their money can be protected and how their money can grow.
Right.
So it's MontelongoCapital.com. Also there, you'll find all of our social media links. And on social media, we post pictures and videos of our properties and education and our events. And like I said, we're extremely active on social media. And you'll find all those links at MontelongoCapital.com.
Right. That's amazing. Yeah, it speaks volume on you guys for being able to inform the people out there that's looking out to invest.
Yeah. We of everything that we do, we find that education is like our most satisfying.
That's true.
Because we're teaching people, we're helping people.
That's true.
And we're helping their families. We're helping them build wealth. We're helping them build legacy for their families. We're doing the same thing for our families, for ourselves. Right. But we also get to share it. So that's very, very rewarding.
Yeah, I'm sure it is. Well, thank you again, Paul.
All right, my man. Take care.
You too. Thanks. Thanks for listening today. Be sure to subscribe to Beyond by Wings on your favorite podcast platform. For more information, you can follow us on Facebook, Twitter, and LinkedIn, or reach out to us on our website. You can also shoot us an email at info@eandassociates.com.